All right. Good morning, everybody. We have CPI today, which gives us an opportunity for a gap close setup. I've showed the setup often enough. Not going to run it again this time, but if you want to see the walkthrough of the setup, you could go to last week when we had non-farm payrolls. I did the same routine on that day to be able to catch it. This is pretty much the last big thing that we have for the week, all things being equal. There's still PPI. I mean, we don't want to say it's not important, but it falls lower down on the impact scale. Japan still down this morning, 1.5%. Hong Kong basically flat. And I was just reading through this research paper that came out on unicorns. If you're unfamiliar with the phrase, it's IPOs with a valuation over 1 billion. They're called unicorns. They're going to have to come up with another name. This used to be, kind of a rare thing back in the day, which is why it was nicknamed a unicorn, because it was such a mythical creature that, you rarely ever saw. Now we're getting 40 to 60 of these a year per country. China had 56 new startups over $1 billion and in this report. So they are second to us in the number of companies that are coming out with over $1 billion valuations in IPO. They're also doing a lot of stimulus still. And, at first we kind of joked that they're doing all that work and they're really not getting any results out of it. But it's cumulative, right? And it's not like they were doing helicopter money. It's just they weren't just, printing money and dumping it into the market. They were doing a lot of subtle things behind the scenes to ease liquidity and promote that stimulus. So we could start to see more out of Hong Kong as the year goes on, especially into third quarter. NASDAQ is down the most out of the US markets, barely above zero. S&P riding above that, and then the Dow. None of those three are even up 0.25%. The Russell is, so we got the small caps. When you have the small caps up, you automatically just want to think about the NYSE, the New York Stock Exchange, and that group being up. Also, kind of consider what groups have been hot lately that fit into that small cap category, like pot stocks. Pot stocks took a beat down yesterday, and they are most definitely a bunch of penny stocks. So small caps, cheap small companies, it makes sense that we're getting a little bit of a rebound there. And then Bitcoin proxies were taking a hit yesterday. Things like Hut and Hive are small companies. They fit into that Russell category. So, yeah, the Russell's up more than the rest, but it's still only 0.25%, and everything is still on pause while we wait for this data. It's a hurry up and wait scenario like it has been all week. I know it hasn't felt like it with some of the moves that we've had, but some of the best plays so far have been trading the edges, right? Caught a really nice short off the highs yesterday and caught that rebound off the lows, at least the first time we went to the lows. With this hurry up and wait, we're going to have most of the information that we need before the open. We're going to know what CPI was. And I seen questions yesterday like, oh, well, if CPI is hot, if it's cold, what if it pushes the markets up? What if it pushes it down? Yeah, what if, but who cares, right? It's after 4, you can't do anything about it. Might as well, get the numbers and then see how the market takes those numbers. And we're still in a situation where bad news is good news. That needs to change. It's one of the fundamental checks in the checkbox for longer term swing trade portfolios. Is bad news bad and good news good? Or is bad news good and good news bad? And right now we're still in the second, where bad news is good and good news is bad. Past the Russell, got Europe on up the most and kind of leading the way. Their economic data, I haven't had a chance to go through it yet, but they had a lot of data coming through, and obviously it was good, or the market took it that way, or Europe wouldn't be up this morning, and up significantly, no less. If we get more of a neutral print, the fact that they're up is going to help us grind to the upside, right? Think about that. If we don't really get anything out of CPI that gives our investors any reason to go long or short, then the bullish bias out of Europe can bleed into us and give us that bullish bias anyways. If we get some neutral numbers, and by neutral, I mean sometimes everything is just so muddy that they call timeout and call the nerds. Then the nerds have to crush the numbers and give them a new valuation, new target, new levels, new game plan. And during that pause, markets can look around and see what everybody else is doing. We're going to get the FOMC minutes today at 2. I continue to see people refer to this as FOMC day. It's not. It's not FOMC day. Completely misleading to even consider it as an FOMC day. It's just FOMC minutes. We are going to get some insight today that we didn't get during the FOMC event. So it's not all just rehashed data. There is some new information in there. Who voted on what the consensus was, what they're looking at going forward. There is data in there that we didn't get when Powell came out chipping his teeth, but it's still not a new FOMC meeting, or it's not another meeting. All right, we got the 10-year at 1 o'clock. That's we're not supposed to say it, but it's one of my favorites. Having a favorite bond is like having a favorite cat. So kind of back-to-back issues today. The crude report at 10:30, and with everything that's been going on, I would certainly pay attention to that crude report today. So at 10:30, we're getting crude. Then we got a Fed speaker chipping teeth. Right behind that, we got FOMC or the 10-year, and then at FOMC minutes behind that. So just back-to-back events stacking up through the afternoon. And overnight tonight, we're going to get a lot of data out of Japan. They continue to talk about intervention too, so that's not off the table. And instead of just slightly raising rates, which is what they had first proposed, now they're talking about a more significant raise in rates. When it comes to the wall of worry, and I've seen a couple people say, well, there's really not much bricks left in that wall. Yeah, this is a pretty big brick. So when it comes to things to worry about, Japan is still front and center on that. They are hedging this morning. CPI has them concerned enough to get insurance. Volume is a little heavier than I would have expected, sitting at 68. but they are sitting out for the most part, waiting on the CPI data. This is not my opinion. I'm not guessing, I'm not making assumptions here. We know that they are hedging because we can see it in that tag right there. That is market maker move. Now, when Tom Sosnoff owned this trading platform, Thinkorswim, before he sold it to TD Ameritrade, they made this up. It's made up, right? Just like everything else that's out there. They just made it up. It has a really nice fancy name to it, market maker move. Oh, wow, that sounds cool. Sounds important. If you don't have the label, you can find the market maker move tag right there, but only if there is a market maker move to be seen. So take a look at TLT. It's got a market maker move today. Everything has a market maker move today. Okay, Alcoa does not have a market maker move. There's no market maker move tag here, right? So it's not something that you turn on or off. You don't have to do anything. If the company that you're looking at or the futures has a market maker move, it shows up here. And if it doesn't, then it does not show up there. That's still a design flaw that I've asked them to fix, and they ignore me, of course, because who am I? I'm nobody. That's a plus or a minus. So we take today's expected move and we add 33 to the upside, take today's expected move and subtract 33 from the downside. It's an additional 66 points between the high and the low that we could move today. And this hedging is because they're trading these out of the money options. And we can even see some of the volume in here already. Them trading in the out of the money options increases the implied volatility value here. And when the front series or the closest expiring options implied volatility is higher than the next series out, then you get a market maker move. Just like that. So we know that they're hedging and we can see that they're sitting out for the most part. The volume's light. The combination of these two pieces tell us to approach with caution, expect choppiness and sideways behavior, and that there's an event on the horizon. The funny thing is, we don't always know that there's an event coming. Today is obvious. We got CPI, no big deal. But if you were to ever just come in one morning, there's nothing really on the table, no economic events expected, you fire up Thinkorswim and you see the low volume with the market maker move, you know something's wrong, something's up. You might not know what the heck it is, but you know something's up because they're scared and they're spending money to protect their positions. So that's kind of the idea behind it, right? Today, we know it's CPI, big deal. We can see it coming. Now, because we've got CPI, there's no reason to try to anticipate pivot levels or anything like that. Because when we get the initial data print, we're going to make a move one way or the other, and pivot points aren't going to stop it, slow it down, intervene, nothing. But we are expecting a liquidity gap play. So there's always that. Just a recap real quick. Get a really big candle like that, consider it a liquidity gap. Price wants to go back up and close that gap. Now, this was just a little itty bitty liquidity gap move, like 4 in the morning, and it was done by 7. But on FOMC days, on CPI, non-farm payrolls, PPI, we have the chance to get one of these. 3 chances a month in the pre-market at 8:30. Generally, we get the gap closed around 11 a.m. too. So we came really close to hitting the ADR full yesterday. Not quite. And we almost made it back up to the gap close. In fact, I think we actually did make it back up to hit that gap close. Sure enough, look at that. Made it all the way back up to where that candle started. Got the gap closed by the end of the day. This is another example of a liquidity gap. So we're back above the 3-week. We're back above the 10-day. We are finally back above the weekly pivot point. We have an MDP, which is a missed daily pivot. We're back above the voodoo line forest. And we're above the volatility trigger, the 0 gamma line, and the put wall. There's not a lot of pivots left over our head to deal with. We have the previous week's high and our ADR half and our ADR full, and around number 5,300. I mean, really, that's not much. And if you look at the CPI, cumulative volume index here, we've certainly come up off of that orange line, which is the 50, and we're trying to get a Bollinger Band breakout on this cumulative volume index. It wasn't quite a squeeze. I wouldn't put it in the squeeze category, but when it comes to these Bollinger Bands, you do want to pay particular attention to the way that the bands are curled. Are they curled in, like they're continuing to compress, or are they beginning to expand or curl out? And at this point, although it's minor, they're beginning to curl out, and it's going to help when this indicator, the CPI, pushes against it and pushes that Bollinger higher. When it widens out this Bollinger Band, gives itself a little bit of room, maybe even breaks out of it, might have to swap over to an acceleration band that Price Headley made. Either way, this is a signal of bullishness in the background, right? The breadth, the deeper volume from not just the Magnificent Seven, right? But from everything else too. I'm still bullish the broader market in the big picture. We have QRA and FOMC combined May 1st. So with everything that you're doing, just keep that front and center. That's going to be a really big deal. All right, 10-day, 30-minute volume profile. We really don't have anything here. And if we were going to say that there's any shape at all, it'd be kind of a classic D shape. It's not perfect, but you know, a lot of times it's not, right? But it certainly isn't like a classic B or a P. So D kind of fits. We've been hovering around the point of control all week. Even with the expansion, we came right back up. So the hurry up and wait call out from Monday was accurate, because that's what we've done all week. Hurry up and wait. We've held the range for the most part. And I talked about liquidity Monday and Tuesday, mentioning that liquidity resides on the other side of the pivot. That if that is the pivot, liquidity resides on the other side. Same thing up here. If that's the pivot, then liquidity resides on the other side. Even if we were just going to get a reciprocation move from one side to the other and focus on this high at 53.11 cog line, we can just project that using the quant levels. And look at that. Imagine that it just lines right up the way it's supposed to, right against that pivot point. So what I say all the time, if you're drawing things from the right spot, it'll line up with everything else. And it doesn't matter if you're using fib lines or quant levels or just draw a box and set it up there. It doesn't matter. So when you're trying to use fibs and you're thinking, should I use the wick? Should I use the body? Should I go from the highest point to the lowest point? Try drawing it from different places and just experiment. You would be surprised at how often it's still going to line you up exactly at a pivot point. This chart really highlights the narrow scope and tone that we've had this morning with this hurry up and wait model all night. We do have a new VPOC from yesterday, although we almost lost it when we dipped down here. I got that reversal, but almost doesn't count. We haven't hit it yet. And we'll just carry it forward. So we can add 52.56 as another pivot to the downside to be aware of. Just remember, this isn't a support or resistance level, right? This is just the location where yesterday it was where the most volume took place. It's where the most trades, basically. The expectation is that if we go back to that spot, there's going to be traders who are going to reevaluate their position, and maybe traders that didn't get a chance to trade there yesterday who are going to take advantage of it and trade there today. We're still 2% above the 10-week. We haven't started to curve back up yet in the histogram bars, but the blue line has definitely started to fade from the top. So we want to see a continuation in this and get some more answers on whether or not we're going to get more of a rounding feature here and start to see these bars head back up, or if we're going to continue the slope lower down to the 10, to the 0. In the bigger picture, the 10-week, we are not overbought. We're not oversold. It doesn't owe us anything. And that big move yesterday, since it was reset yesterday, doesn't affect anything. Even here, we can see on distance from 10-day, we're back above the 10-day. We made it back above there yesterday. We're still there this morning. It's a precarious situation at the moment. We're just hovering right there near it, but we've crossed above and below and around it so many times now that there's no respect for the 10 at this point. We wouldn't see it as any form of support or resistance, or even as a tradable area, metric, a zone where we would expect liquidity, nothing like that. Until we leave the 10 and then get some distance from it, price won't have any respect for it at this point. The hurry up and wait call out from Monday. One of the things we looked at was where we closed on Friday. So Monday we opened it gapped up. We didn't keep it. Tuesday, we opened gapped up from where we closed on Monday and really sold off, but we got back up. This gray line represents where we closed on Friday. And we have done nothing since Friday. So let's get through CPI and take a good look at what is up or what is down after CPI. The data comes in at 8:30. Right before the open, right around 9:30, it would be an hour later. By that time, you should have a really good idea. We should easily be able to see the ETFs that are up and the ETFs that are down before the open. The ones that are up right now, maybe they keep their position and go higher, maybe, but we can't expect them to make it through the other side of CPI. So I wouldn't even waste time digging through these yet, because until we get CPI, we just don't know what's going to keep its current position and what's not. At a glance, if there wasn't CPI, then we've got China again, nat gas, jets, and uranium. Those are the things that are up. And for what's down, there really wasn't anything down per se. The FANGs mildly down. I mean, below zero is just kind of lifts your eyebrow a little bit, but nothing, right? So let's get some CPI data and we'll have a cleaner picture of what we're going to do from there. Since we don't really have the equities to go through, take a moment to take a look at the NASDAQ. This is the candle of control, the last big candle. We're on a daily chart. You see how price kept coming back up. They had kept defending that halfback. So that's kind of the line in the sand we need to keep. It's a round number. You could just say 18.3, right? Just for some easy instead of 18.311. Needs to really close above 18.3 and really, not just on the day, but on the week. Looking at the 10-week, we can see this just perfect run of riding that 10. It hasn't had a reset or a close below the 10 since that QRA back in November last year. And the only real actual close week down was FOMC back here at the January FOMC. But we're stalled out. We were stalled out here, honestly, way back here. That was just a little peak higher, but we're still stalled out. If we're going to resume this run, that would be my entire focus for the NASDAQ in an expansion. Got to get through the trash. All of these sellers is a part of the problem. So we got to take that out. And so far, anything above 18.5 hasn't made it, right? Every time we've tried it since we peaked out at 18.7, there's just been nonstop selling every time we come back up into that zone. So that's really got to change. On the other side of it, this doesn't inspire a lot of confidence. This flip down here off the lows, that 1800 flip. Same thing back here. But that's not very inspiring. And it didn't even make a classic double bottom like you would expect to see. Instead, it formed more of an inverse cup and handle. Like I've talked about before, when you've got price that comes over and comes back to the previous bottom, it needs to go lower than the previous low so that we get that double bottom and make the move to the upside. It's a bear trap. It needs to go lower to trap the bears. And if it doesn't, then it doesn't really look like a trap and it didn't do its job. But on the other hand, if it's a cup and handle, oftentimes it'll stop or it'll come up a little short and it'll make that handle and then it continues to the downside. So right now we came up short. We didn't even match that low and we've pulled back to the distance of where we would expect to handle, maybe a little too deep, all things considered. A typical cup and handle shouldn't have come back that far, but things overshoot on the NASDAQ. So we've got our handle, we've got our cup, and since it's inverted, it kind of gives us levels to the downside. Don't fall victim to this trick of price, right? On the indexes, the S&P and the NASDAQ, price will show you price patterns, signals, setups that say we're going lower or we're going higher. And then things like CPI, non-farm payrolls, FOMC, economic data prints, things like that, make us do the complete opposite, right? I've seen it so many times that, especially in a day trade, it's one of the things that I see newer traders struggle with. is they'll be trying to trade the futures, and they'll literally be trying to trade what the candles are telling them, that we're breaking out, we're breaking down, that price is accelerating, the move is strong, and then it'll just flip and go the other direction on them because bias was more important than the candle pattern. So we do have that inverse cup and handle out on the daily, but just keep that but in mind. The evaluations in the econ data is going to be the deciding factor, not that pattern. Watch the clock, guys. Be careful, be safe. I'll see y'all tomorrow.